Today we will explore what Keltner channels are, their history, and their logic. Most importantly, we will uncover the reality behind using this chart indicator with extensive data and backtesting. Are Keltner channels truly valuable for traders? Let's find out. Keltner channels are a technical analysis indicator that helps traders identify entry and exit points in the market.
Comprised of an upper band, a middle band, and a lower band, these channels are based on the average true range, which measures market volatility over a specific period. These bands provide valuable buying and selling signals for traders. Developed in the early 1960s by Chester W. Keltner, a grain trader, Keltner channels originally quantified prevailing trends in commodities markets. Over time, it found adoption in stocks, currencies, and other markets worldwide due to its visual breakout identification and risk management capabilities. The Keltner channel indicator suggests potential buy or sell signals when prices move above or below the upper or lower bands. These movements outside the channel indicate shifting price momentum, prompting traders to adjust their positions accordingly. Sideways movement within the channel may indicate consolidation before another significant move. Keltner channels use an exponential moving average to mark support and resistance levels, with the upper and lower bands plotted 2 times the ATR away from it. They help traders identify potential breakouts and gauge the strength of a trend. However, their profitability has been a subject of debate.
Although our testing shows that Keltner channels are not profitable, we'll discuss common trading strategies for informational purposes. The Keltner channel trading strategy number 1 is the buy oversold and sell overbought method, a momentum strategy that relies on the assumption that prices will continue in the same direction. And the Keltner channel trading strategy number 2 is the buy overbought and sell oversold method, another popular strategy that involves buying when the price is above the upper band and selling when it crosses below the lower band. Keltner channels offer traders a way to identify potential breakouts and manage risk. However, their main disadvantage lies in generating numerous false signals, leading to unprofitable trades. Keltner channels lag and react slowly to price movements, resulting in many false signals.
Additionally, their width may not accurately capture market volatility, further impacting their usefulness for profitable trades. Also, Keltner channels are a poor indicator with an average 28% win rate.
In conclusion, Keltner channels, while a visually appealing tool for traders, may not be as reliable as originally thought. Our extensive data-backed analysis reveals that they are not a profitable indicator. As with any trading strategy, it's essential to thoroughly test and validate any indicator's effectiveness. Armed with this knowledge, traders can make informed decisions and optimize their trading strategies. Free and pro investing courses, strategies and original research at liberatedstocktrader.com.